Welcome back. U.S. markets are down significantly while the TSX Composite here in Canada is posting a modest advance. We're joined now by Jason Del Vicario. He's portfolio manager at Hillside Wealth Management, IA Private Wealth. And he joins us right now. Jason, thanks a lot for joining us. We've got lots to talk about. Why don't we begin just with some quick thoughts on today's sell-off? We're in a very fragile period of market psychology. It didn't take much to tip these markets into negative territory again, and the catalyst this time around was a warning from a social media player, Snap.
Right. Yeah. I mean, there's a tug of war really going on with the markets right now. We're seeing, as you said, huge volatility. I mean, it's not uncommon these days to see the markets up or down 2%. I'll just say that this is normal volatility in the context of the broader correction, sell-off, bear market, whatever we want to call it, that's been going on here for the last few months.
Inflation was one of the things that Snap cited in its warning, and that may be one of the reasons that the sell-off is so severe, because inflation affects companies in all sectors. What are your thoughts on investors and how they should be positioned in an inflationary environment?
Yeah, great question. So there's a letter, the 1983 Berkshire Hathaway letter, that, of course, written by Warren Buffett, is something that I think all investors should have a little peek at if they have the time or the care. But I'll summarize it briefly here for us. Basically, we want to be looking at companies that are asset light, because the general narrative is that commodity type companies, real estate does really well in inflationary environments. When we look at specifically commodity type companies, not only do the prices of what they sell go up in an inflationary environment, so think gold, oil prices going up, but the input costs to extract those minerals and get them to market also goes up, meaning that the actual bump in net profit or net income may be smaller than the top line would indicate, and in fact could be negative if the input costs, so again, fuel, if you're fueling trucks to get the ore out of the ground, et cetera, goes up faster than what you're being able to sell these things for. If we look at a company like Snap, and I'm not too familiar with Snap, but we do own Meta Platforms, so I'm familiar with them, we would consider these to be asset-light business models. I mean, if we really think about it, yes, Meta, formerly Facebook, is spending a lot of money on Metaverse, but if we strip that out, it's just a website. And yes, that requires maintenance. And yes, they're having to spend a lot of money on content supervision, et cetera, et cetera. But the actual cost to run Facebook or the cost to run certain businesses can be a lot lower than commodity type of companies. So in short, I think that investors want to favor companies with strong returns on invested capital, pricing power, and perhaps most importantly, and something that isn't very well necessarily understood, asset-light business models that require low amounts of capital to maintain, sustain, and grow their operations.
You're a skeptic, in other words, on the commodity stocks.
I am. Now, in the short term, of course, I mean, they're cyclical. They do something like this, and we're looking for companies that are going from lower left to upper right. So it's not necessarily that I'm skeptical. It's just that if you look at commodity companies, their returns on invested capital go up and down, depending on where the commodity prices are going. And over time, especially in real terms, so again, inflation adjusted, the price for oil and gold and iron ore, et cetera, tends to be relatively flat. We're looking for companies that can compound shareholder wealth and produce high returns on invested capital year after year. And those are those sort of coveted holy grail compounding machines that I think investors should be looking for regardless of the inflationary environment.
Okay, so let's bring up a board of some of your investing ideas. There are 3 stocks listed here, and the first one will dovetail very well into the conversation we've just had. The first one is Meta, the company formerly known as Facebook and almost universally understood by the markets to be Facebook. Have you come to favor this one because it is so cheap compared to where it's been recently?
We've certainly added to it because it is so cheap, but from our perspective, we are bottom up. So we're always looking at business models first. The valuation work that we do always comes at the end of our process. So we liked Facebook even in the 250, 300 range. And if we liked it then certainly we love it at these prices. And I note today it's down another 8%. So yeah, I think for the long-term investor, so somebody who's not looking beyond months, ideally years or decades, Facebook has shown that they can continue to put up high returns on invested capital. They've had tremendous growth in free cash flow. And yes, if we look at their free cash flow yield right now at 5-6%, we feel that that is incredibly inexpensive in the context of other large tech plays and so on and so forth.
It's a giant, of course, in online advertising, and you see it holding that position in years ahead.
We do, yes.
Okay, one thing that's always interesting about a conversation with Jason Del Vicario is that you bring us stocks from foreign markets that investors here in Canada may not be familiar with. One of them that you like right now is a company called Rightmove that trades in London. Tell us about Rightmove.
Right. So Rightmove, I mentioned in my notes for today's call specifically because it is an extremely asset-light business model. So we do own shares in the company. It has certainly come off with a lot of the other growth names as those higher rates get inputted into people's discounted cash flows. But if we think of Rightmove, Rightmove is essentially the Canadian equivalent of MLS. And in that sense, it's a bit of a classifieds business. And classifieds is a winner take all. You usually only have one player in the space that dominates, and Rightmove is that player in the property search market in the UK with over 85% market share. If you look at their returns on invested capital, their margins, I think their net margins are something like 75%. They produce lots of cash. When we think about downside protection and minimizing the permanent loss of capital, these are the types of business models that don't require a lot of capital to grow, don't have a lot of debt, don't issue new shares. In fact, they're buying back shares and are able to pay a dividend. There's just layers of bulletproofness, if you will, to this type of business model. So it is a company that we like very much, and it's down, from its highs. So if you don't have a position, it would be a reasonable time or a level to add to it.
And the third stock on this list is a company called Bouvet. I have it as a infotech consulting company that trades in Switzerland. Is that correct?
It actually trades in Norway, so it's on the Norwegian Stock Exchange. But you're right. Yes, they're a consulting company. So far, they've stayed within the boundaries of Scandinavia, so they are active in Norway and Sweden. And again, this is a business model that does not require a lot of capital to sustain and grow. However, with a consulting business model, you still do need headcount, i.e. consultants, to be able to execute the business model. So to the extent that we are seeing some wage price pressure, that could be something that may affect their operations. But again, this is a very well-run company, founder-owned, founder-run, pays a nice dividend, and one that we hold here at Hillside for our clients.
What is your view of publicly traded real estate, the Reits, right now?
To be honest, it's not an area that we look at simply because they just don't have that history of the return on invested capital that we're looking for. Not only do they not have the history, but they generally don't have the levels. But I do understand for investors who are looking for exposure to real estate, I think REITs, and I think you need to be very, very specific and particular in terms of the REITs that you buy, can be a great way to gain diversified access to real estate. The one thing I would look at if I was looking specifically at REITs would be to look at what the costs are for running that REIT. So all the management costs, consulting costs, et cetera, and divide that by the capital that they've deployed. And I think you really want that to be under 1 or 2%. Otherwise, your returns are going to be severely impacted by the operational and headcount costs of that entity.
Okay, let's finish with the big macro question that investors are fixed on right now. Inflation, where's it going? You actually believe that the concern could devolve before long into deflation, that we could be back into a market more concerned about retreating prices and retreating consumer spending.
Right. So with the caveat being that we have no idea what's going to happen, and predicting the unpredictable is not our wheelhouse here at Hillside, I will give you my best guess stab at where we're headed here. And I think we are seeing the same movie that we've seen over and over and over again since 2008. And right now we're in the period where inflation has picked up. People are talking about runaway inflation, and we've heard the same type of chatter in 2009, 2018, et cetera, et cetera. But the fact of the matter is pre-pandemic, all of the factors that were in place that led to low inflation or deflation are still there, namely demographics, so our population is getting older, productivity, so the actual productivity of the workforce is going down, the velocity of money, meaning the amount of time the amount of times the money circulates through the system is going down, technological advancement and innovation, which of course brings down costs and brings down prices, that is certainly increasing. So all of these factors are still in place, but we have a massive stimulus that was put into place through the pandemic, and now we've got this war that's raging between the Ukraine and Russia. So we've got all of these factors sort of competing with each other, and then of course the big elephant in the room is the Fed. The Fed is raising rates, and they're starting to reduce, they've actually stopped QE and they're going into QT, quantitative tightening. My best guess is these rate rises. So when you go from 1% to 2%, that is a 100% increase in interest costs. It's not like going from 9 to 10%, which is an 11% increase. If we go from 1 to 2 to 3%, we are going to see consumers who are 70% of the economy start to pull back because they're having to allocate capital that was otherwise allocated to discretionary spending to interest payments. So my best guess is we are at or near peak inflation. We will see inflation start to come down. I don't know when the Fed steps in, whether it's a 20, 30, 40% market drop. I know they say they aren't stock market dependent, but they've shown time and time again when push comes to shove, they will always back away. And so I suspect if inflation starts coming down and the markets continue to slide, we'll have the Fed say, just kidding, we're going to stop raising rates, or we're going to start lowering rates to stimulate demand again, and then the cycle starts anew. So as I said, that's my best guess. But regardless, I think investors want to focus on high quality, predictable businesses that are asset light.
Jason Del Vicario, thanks for this conversation. He's portfolio manager at Hillside Wealth Management, IA Private Wealth. He joined us from Vancouver.